Hi everyone. Today we will be overviewing chain financial model. So this may be a chain of grocery stores, pharmacies, different types of stores. So in this particular model we will be starting 50 stores or 50 groceries or 50 pharmacies, so it doesn't matter. So I will be overviewing the inputs that affect chain financial model. So if you find this financial model overview valuable, please give us a like, subscribe our channel. So we've created more than 400 financial models, so we will be posting them on this YouTube channel, so stay tuned. Also we will be posting some Power BI tutorials. Today we will be focusing on chain financial model. So first of all, we need to state the rule that all our inputs will be colored with a specific color, with blue. So these are the inputs, these are the inputs, these are the inputs. So many steps ahead, when we will finish this model, we will need to be able to easily find and play with all the inputs. That's why we need to highlight them somehow for us, for scenario building, for the stress testing, for all the third parties who will be using our financial model, like investors, bankers, your business partners. So all the inputs should be able to so they need to be findable in a very easy way. That's why we need to highlight them, because you will be playing once your financial model is ready, you will be playing with scenarios. You want to know how stable this or that scenario is, what are the strengths or weaknesses of this or that scenario. So you'll be playing with the inputs a lot, so you will need to be able to find all these inputs easily. So that's why you need to highlight them. So first input is the first year of financial projections. So once you, for example, select here 2021 or 2026, all timeline in our project will be starting from this year. In this particular case it's 2020, but we can easily start it with 2025, and all the timelines will be starting with the 2025, for example, or 2026. We don't need manually to adjust all the timelines, so this can be easily done in one place here at the very beginning on the top. Then we need to specify the types of stores or types of shops or types of groceries that we will be opening. So in this particular case we have 8 types of shops. So let's assume we are opening some kind of shops chain, and we have 8 types of shops. So in this in this block of inputs, we can easily switch them, each type on and off from calculations, and see the simple and discounted payback period with or without this or that type of shop or type of grocery or type of pharmacy or type of store, doesn't matter. So you can quickly switch this type of shop from calculation and see the cash flow statement and P&L statement and simple discounted payback period and all the financials, financial efficiency number with or without this or that type. Remember, type of shop. This will be very valuable during scenario playing. So many steps ahead, when your financial model will be ready, you will need to switch on and off different types of shops and see how your project will be, how your numbers will be looking in this or that scenario. So this will give you huge flexibility in scenario building and stress testing environment. Then for each type of shop, we need to set up the life cycle, because some shops you will be opening, they will bring you losses and you will be closing them. So some types of shops will be successful and the duration of their life cycle will be long, and some shops will bring you negative EBITDA, so you will be closing them. So here we're specifying the duration of the life cycle in months for each type of shop that we will be opening. So here it is. So here we can name the type of shop, here we can switch on and off different types of shop, and here we can specify the duration of the life cycle in months for each type of shop. Then we have two quick options. So this is the depreciation term in months for the investment plan items, and here is the direct cost offset coefficient, meaning that if we set up here 1, if we set up here 0, this means we will be financing direct cost right from the revenues from this particular month. So you don't need to, for example, so you will be receiving the revenues, and then you will be financing all the direct costs. Also, you can set up here a 0, meaning meaning that there is an offset. So for example, first of all, you need to buy the some raw materials. So first of all, you need to finance your direct costs, and then only then you will get the revenues. So this means this will increase your the amount of financing that you will need to start. If you finance first of all the direct costs and then you get the revenues, then we are placing here 1. So you can, for example, play with this switcher, this button, and looking at how much financing you will need in this or that scenario. So 0 means that you are financing your direct cost from the revenues of this particular month. 1 means first of all you need to buy something, and then you will be only selling them. So all these items. The second scenario says that you will need more money to start the business. So playing with this coefficient will show you how much you will need financing in this scenario or that scenario. Then we're moving to the investment plan. So here on the top in violet cell we have the type of shop. So this comes from this menu. So these are 8 types of shops. This is shop type number 1, and this is the investment stage. So here is what we are investing in. This is the investment stage for this shop type of shop. This is the moment when we are opening this shop. This is the moment when the revenue begins, and from this moment to the past we are counting months of investment stage, and here we're specifying how much we are investing in this type of shop during this 6-month investment stage. So this is the investment stage, investment plan for the shop type number 1, number 2, number 3, number 4, and number 5. So here we covered number 6, number 7, and number 8. We have 8 types of shops that we're gonna open. So now we've covered the investment plan. Now we're moving to the fixed costs for all 8 types. Here from left to the right we have a typical year where we will be specifying the fixed costs for all types of shops that we will be opening. So here from top to the bottom we are specifying the fixed cost items, and then from left to the right, if we have any seasonality in fixed costs for each type of shop, we will be specifying it here. So despite of these costs being so called, they may also have some individual algorithms. So some of fixed costs you will be paying once a year, or once in a quarter, once in 6 months, or you may be paying these expenses, for example, in January, February, and September. So they may have some specific algorithm. We can specify this algorithm here in this menu. So for each type of shop you will be placing fixed costs here. So these are the fixed costs for the shop type number 1, number 2, number 3, number 4, 5, 6, 7, and 8. Now we're moving to the payroll. The same story. From top to the bottom we have the list of positions for each type of shop. Then we have the payroll per month per person on each position, and here we have the typical year, where we can specify the amount of people on each position. So if we also have some seasonality affecting the amount of people on each position, we can specify it here inside the typical year. As a result, we will get the payroll for the shop type number 1, number 2, 3, 4, 5, 6, 7, 8. So we have 8 types of shops. Now we need to describe the revenues. So let's assume for shop type number 1 we have 3 types of customers. We can specify here the average check for each type of customer. Then we can specify the margin sitting inside the average check for each type of customer. Then we have shop number type. We have 3 types of customers for each type. For this shop type number 2, this is the average check, margin sitting inside the average check. So the same story for all 8 types of shops. Now we need to specify how many checks we will be producing each month. So this is the shop type number 1. We have 3 types of customers that we introduced earlier. We have the typical year. If we have some seasonality inside the typical year for the amount of checks that we get, we may specify it here. If we have some increase in summer or decrease in summer, so we can specify all these peculiarities inside the typical year for each type of shop. So that's how we calculate the revenues. So in previous menu we were specifying the average check for each type of customer. Then we were specifying how many average checks we are producing every month inside the typical year for all types of shops. Then we have a very important block of inputs. So we won't be able to reach these target revenues right from the first month of operating activity. So we will be reaching the target revenues month by month, step by step. So here from top to the bottom we have all our 8 types of shops, and from left to the right we have first 2 years of operating activity. So this is the first month of operating activity, second, third, fourth, fifth month of operating activity. And here we can specify for each type of shop that we will be opening. So for example, the first month we will be getting only 3% of target revenues, then 6, 9, 12%, 15% of target revenues. And for each type of shop we may specify its own algorithm of reaching the target revenue. So this is very important. So once your model will be ready, you will be playing with all these percentages very often, very long. It will take you a long time. You will be building lots of scenarios, because all these percentages affect the amount of financing that you will need to start. This will affect the financing if we go to the cash flow statement. This will affect the operating losses. You can see the cash flow from operating activities. So this percentage will significantly affect the operating expenses. It will give you this may give you the losses, and you will have to add these losses to the investment stage expenses. Here they are. And as a result, these expenses plus operating loss, this is investment stage expenses plus operating losses, they will give you the total financing that you will need to start the business. So playing with these percentages will give you the difference, the gap, the corridor between optimistic and pessimistic scenario of your business development. So in this scenario, if you reach the target revenues faster, you will need less financing. If you will be reaching the target revenues, it will take you more time. You will have to finance your business, let's say, for a longer period of time, let's say a year or a year and a half. That's why you will need more financing, you will need more loans, and so on. So you will be playing with all these percentages a lot. Then we're moving to the most important part of this financial model. So here we have this is the central part of the model. So here you can specify what. So this is the list of 50 shops that were capable of opening, and we can specify, for example, so what type of shop we will be opening. So we want to open shop number 3. We can open this shop, let's say, in 2022 in April, and this will affect the cash flow statement, simple and discounted payback period, and so on. Then we would like to open shop number 6 in 2026 in for example in October, and here you can quickly switch on and off different stores from calculations, see how this affects the cash flow statement, simple discounted payback period, and so on. So here you don't have to retype all the investment plans, all the payrolls, all the fixed costs, all the direct expenses, all the revenues, all the investment plan expenses. So everything is linked to this menu. So here you have you can set up the parameter for 50 shops. Every shop can represent shop type number 1 or number 2 or number 3 or number 5 or number 6 or number 7 or number 8. So for example, this will be type number 7. You can switch it on, see how the project will be looking if it is on, or you can switch it off and see how the cash flow statement will be looking without this particular shop. Let's switch it on. So you can add up to 50 shops inside this model and see what will be the cash flow statement in this or that scenario. So usually when financial model is ready, so entrepreneurs are playing with this menu a lot, so they are experimenting. So if you open all the shops in one time, you will need more financing. For example, if you will be opening one by one, you will need less financing. So now we're moving to the next block of inputs, that will be taxes. So for different countries we have value-added tax, asset tax, salary tax, net profit tax, revenue tax, revenues minus cost tax. So these are the percentages rates for these tax. This is the tax base, added value, assets, salary, EBITDA, profit, revenues minus cost, and so on. This is the finally, this is the cash flow statement. Here we can see how much financing we will need in this particular scenario. Equity plus loan. The last line of the cash flow statement is showing us that we are eating the cash during this period of time. So we are eating. This is mathematical zero, and this is the moment when the project starts generating its own EBITDA, its own profit. And we can see, for example, if we need roughly $15 million, we will be able to see when the project will be generating these $15 million. So this is zero. Here we will be able to, we're looking at the cash balance at the end of the period. When it reaches $15 million, this means that the project gave us all the financing that we've invested. So this will be July 2025. Then we have the discount rate that will affect the discounted numbers, like net present value, profitability index. So here we have main financial numbers: simple, discounted payback period, profitability index, net income, net present value, total financing needed, that consists of equity plus loan, internal rate of return for this particular scenario. Then we have several loans that we may add to the project. We can specify the amount of loan, when we get this loan, year and month. This will be the term of loan, interest rate, if we have any grace period for the principal or for the interest in months, we can specify it here for each loan. The next tab is showing us the main chart: simple, discounted payback period, loan coverage ratio, revenues and total costs. If we have any seasonality, we can see it here. The profit, profitability monthly. This will be cash balance at the end of the period, operating profit and debt payment. The same charts done by here: revenue, total cost, profit, profitability, cash balance at the end of the period, operating profit and debt payments, loan coverage ratio. Here we have the cash flow statement done yearly, P&L statement done yearly, the main parameters of this scenario: revenue, total cost, profit, profitability, cash balance at the end of the year. And then we have very important block, several blocks of sensitivity analysis for the revenues, payroll, fixed cost, direct costs, investments, interest rate, loan amount. So here we can specify the step of changing of the revenues, increase or decrease. This will affect this line. So for example, we can choose the step of 10% or 15% or 20% and see, let's say 18%. So we can press the sensitivity button, see what will happen with financial efficiency if the revenues will increase on 18%, 36%, 54%, 72%. Or for example, what will happen if revenues increase by 15, 30, 45, 60%, 75%, or if the revenues decrease on 50, 30, 45%, and so on. So then we just need to press this button and see the financial efficiency. Now we can do the same for the payroll, for the fixed costs, for direct costs, for investment plan expenses, for the interest rate, and for the amount of loan that we need to start. So once your model is ready, you will be experimenting with sensitivity analysis a lot. So you will be building different scenarios. Then you will be going to sensitivity analysis tabs, pressing this button, and see how stable your business idea is. So that was chain financial model. If you find these financial models overviews valuable, please give us a like, subscribe our channel. We will be posting a lot of such financial models. We have more than 400 models, so stay tuned. I will also be posting some Power BI stuff. So see you next tutorials, overviews. Thank you and bye.